love flopping a jack. Ooh, I'm always on the lookout for viable pullbacks in high-quality stocks. And that's exactly what we got today in Dine Brands Global, the parent of Applebee's and IHOP, formerly known as Dine Equity. For years, Dine Brands was a serial underperformer. The company just could not get out of its own way. And that weakness ultimately cost longtime CEO Julia Stewart her job in 2017. Then they brought in Stephen Joyce to run the business, and he has executed a magnificent comeback. Last year, the stock rallied 33%, and so far this year, it's up 41%, even after today's nearly $5 pullback. So I have to tell you, I'm putting my neck right in the pancake here. I think you should pounce on this pullback. It's exemplary of what I've been talking about for 2 weeks now during this crazy earnings period already, and I'll tell you why. But first, let me tell you a little story about how Dine Brands got its groove back. The modern-day Dine Brands was created 12 years ago when IHOP acquired Applebee's. The deal was supposed to be CEO Julia Stewart's crowning achievement, but it took place right before the financial crisis. The stock ended up plummeting to the single digits shortly after the merger was completed. Ugly. Like many other stocks that cratered during the Great Recession, Dine came roaring back along with the rest of the economy, with the stocks surging to 115 at their peak in 2015. Not bad, huh? Then everything fell apart again. By August of 2017, Dine Equity was a $36 stock. Brutal. So what went wrong? A lot of things. First, Applebee's had been stagnant for a while, but then it became a serious underperformer with same-store sales down 6 or 7% for most of 2017. Very hard to come back from. Then IHOP, which had previously been one of the most consistent restaurant brands around, started showing weakness of its own. Now, Stewart blamed the weakness on the company's franchise-heavy business model. They didn't have enough control over the franchises to turn things around. They needed more control. Their locations needed a lot of investment to improve the experience, and that just wasn't happening. After putting still one more disappointing quarter in 2017, well, you know what happened? Well, Julia Stewart resigned. You know, liked her on the show, but she resigned, and it takes Dine Equity nearly 6 months to find a replacement. Eventually, they settled on Stephen Joyce, who takes over in September of 2017. Now, do you know the stock literally bottomed the day before the announcement, and this stock has not looked back? I mean, talk about a turn in the flap stack. How has Joyce pulled off this miraculous rebound? First, he took a few months to figure out what the company needed. Then in February of last year, he rolled out his plan. And even before the rollout, the numbers had already started picking up, especially at Applebee's. So what was his plan? Okay, first he rebranded the company from Dine Equity to Dine Brands. Superficial but catchy. Then he announced a bunch of growth initiatives. Joyce had shifted resources away from headquarters directly to Applebee's and IHOP, so they'd be able to more quickly respond to changes in the competitive environment. You know, people want more taco stuff, you know, and you get it. I mean, this is certainly more in sync. How many days old is this food? Can I eat it without dying?
You can eat it. We just got it.
Oh, okay, because it just got it, apparently, and hurt. Now, he brought in a new leadership team. He embraced analytics to figure, not as good as Bar San Miguel, to figure out their customers. My mother always said you cannot talk with food in your mouth. So just a second.
There's a drink right there for you.
It's out of respect to my mother. Shut up. Okay. Now, and then what they want. At the same time, Joyce invested in technology to make the stores more efficient, build a better takeout platform. We know how important that is. Finally, he used his new consumer insights to make better. I'm sorry that I said shut up. That was very bad. Can I cut that out?
I thought it was a shout out.
No, I said shout out. I didn't say shut up. Yeah, that's bad.
Shout out.
Anyway, they wanted them to use strategic decisions for each brand. It makes their advertising more effective. It helps boost traffic, helps them figure out what new menu items to introduce. This is about artificial intelligence right here, right in front of us. However, there was also a catch. Joyce also slashed Dine Brands' dividend. I mean, that was something that not a lot of people were expecting. You know what I mean? And slashed it. That's better. Wall Street had long expected from 97 cents to 63 cents a share. Company needed the extra capital to invest in the business, but he also expressed confidence in his ability to gradually grow the dividend over time. Finally, Dine Brands introduced its very own 5-year plan, like the 5 years it's going to take to clean up this mess. They forecasted low single-digit same-store sales growth with earnings growth in the high teens and 10% margin expansion, resulting in total annual shareholder returns of roughly 20%, and that's after the dividend slash. In response, the stock, it caught fire. And it's continued to run and run and run as management's been able to deliver on its promises. Last year, Dine Brands posted a series of excellent quarters. In fact, the plan is going so well that they're expanding the store count and really pushing the delivery business, where they have a partnership with DoorDash. Boy, are they everywhere. Talk about venture capital money. This February, we learned that Applebee's franchisees had agreed to temporarily spend more money on advertising. It's very hard to get the franchisees on board, but Joyce did it. Remember, that's what Easterbrook did at McDonald's to first start turning that operation down. Get this. As a result, Applebee's, remember I told you it was low, mid to single digit down? They posted 7.7% same-store sales growth in the fourth quarter of last year. That's an extraordinary turn. At the same time, we restructured the company's debt, shut down underperforming stores that were bleeding money. Those numbers were so good that the stock exploded higher in February. Most of the gains for 2019 came from that epic run in the first couple months of the year, but the turnaround plans keep paying off. And in recent weeks, it looked like the stock had caught fire again. That is until today, when it ran headfirst into a brick wall. More on that later. When Dine Brands reported its last quarter at the beginning of May, the company delivered a mixed quarter. While the earnings were better than expected, the same-store sales numbers were weaker than anticipated. Applebee's was only up 1.8, IHOP up 1.2, when Wall Street was looking for 3.4 and 2.3 respectively. But on the other hand, management reiterated every line of their previous guidance, suggesting that they still have confidence in the future. I wasn't worried by this seemingly mixed quarter, and I'm going to tell you why. The reason the same-store sales look weak, it's because this was the first quarter when Dine Brands was lapping positive comparisons. What matters to me is that the earnings power was so impressive. Now, the stock tumbled 4% on the news, before rallying 4% the next day, as investors realized the quarter was actually better than it looked. This company's not well followed. It's not in the media. It's got a kind of a, let's say, information vacuum. Dine Brands started bouncing again, although in recent weeks the stock's lost its momentum and it got pulverized today. What happened? Well, there's an outfit called Bloomberg Intelligence, from an arm of Bloomberg. Basically, they're in-house analysts. They're pretty good. Published a note saying that Applebee's same-store sales may struggle in the quarter they're about to report. They're worried about the tough comparisons, as Applebee's saw its same-store sales increase by 5.7% in the period last year. And in fact, they're arguing that the easy money here has already been made. Now, legitimate. The comparisons for Dine Brands do get tougher going forward. But I think the stock has more upside, in part because it's so darn cheap. It sells for less than 12 times next year's earnings estimates, for heaven's sake. 2.9% yield, which means something in the environment where the benchmark 10-year at 2.1. Bottom line, Stephen Joyce has engineered a spectacular and completely and totally unheralded comeback at Dine Brands. No one's talking about this, at least until today when they sold it down. By embracing technology in order to figure out what his customers really want, he's a winner. Yes, the stock has had an incredible run, but I think it's worth buying on any meaningful pullback. And that's exactly what we got today, thanks to that thoughtful Bloomberg Intelligence note about tough comparisons. Don't get me wrong, the comparisons do get more difficult, but the stock is so cheap that I think it's worth the risk. How sweet it is. Actually, there's nothing in here. All right, let's go to Emil in Illinois. Emil.
Hey, Jim, how you doing? First-time caller, so I got to get a booyah in. Booyah!
I like that. There you go. I mean, I got to tell you, I say, what's happening?
Shake Shack has had an amazing year, and it's currently trading about 60% above its market value year to date.
Yes.
With a market cap of $2.7 billion and plenty of room to grow. Do you think it has the potential to be the next Chipotle of burgers?
A lot of people felt that originally, and then it kind of faltered. Using Chipotle as an example is pretty, I don't know, that's pretty high. The bar's too high. But look, the numbers were good with Shake Shack. The numbers are good. It is far more expensive than some of the other restaurants that I follow, though. So take it with a grain of salt. They are on a roll. It's a good spec. How about Robert in California? Robert.
An earthquake shake booyah from Southern California.
Always worried about those. Was in one myself when I lived there. How can I help?
I want to say thanks for Confessions of an Addict. It allowed me to trust the wisdom of a man who knows investing, and to then read Real Money to begin my own path to learning. Back at the end of October, you interviewed Charles Morrison, and the result was a positive support of Wingstop. I did my own homework, thanks to Get Rich Carefully, another great piece of work, and I bought the stock November the 8th at $67.80. Since then, with dividends as well, the stock's gone to 97 and change. Somebody's selling, but others have done their homework and are buying. So what do? Hold,
okay,
sell
Robert,
some,
we had an outfit called
more on dips.
We had an outfit that I like very much. It's called Web. Thank you for the kind comments about every single book that I've written. We had a very interesting piece by an outfit called Wedbush saying that the target had been reached and the stock's too high. Do you know historically that's exactly what I'm teaching you? Wait for those opportunities and then you buy. Because Morrison's doing a great job. I got to tell you, I think he is one hell of an operator, and I think that Wingstop is one hell of a stock. Sometimes I dream that perhaps one day I can own 23 Wingstops in my own hometown of Philadelphia. But you know what? It better start happening soon. Hey, look at this mess. It's all cleaned up, and yet here I was about to slash the... Never mind. Sure, Dine Brands has had an incredible run. Look, do I ever not use every chance to put the Bowie knife out? But I still think it's worth buying on this pullback we got today. And what a comeback the company's made. I think it's worth the risk. You know, there's much more Mad Money today's. Domino shares talk about getting singed, if not burned. They got crushed. So is it time to buy or take a pass? I've got the exclusive with the CEO everybody's talking about. Then is it time to approach the market with fear and trembling? I got to go off the charts with someone who's been so bullish to find out. And I got a little memo there for the Facebook witch hunters and the Google people who don't like that either. You're going to love that, believe me. And so is Senator Joe McCarthy, who's rolling over in his grave. Stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.